Thanks for coming along today. I want to, talk about some of the topical issues on real estate broadly, touching on the Australian residential market, which everybody obviously has a vested interest in, the implications for the Australian economy, and what we think to be the important issues for global real estate and global REITs in particular. I want to try and dispel some myths around the return characteristics of the space and highlight the things that are the things that you should worry about when you look at global REITs, because the fixation with... Oh, thank you. I'll make sure I got the right one here. I managed to press the right one. The fixation on interest rates, we think, with REITs really misses the point. I want to talk about that aspect and why we think REITs can provide a form of diversification in portfolios. But first of all, I just want to talk about Australia's Achilles heel, as we see it. It's not news to anyone that the Australian residential market has tipped over on the East Coast in particular. And it's that combination of high asset prices, high debt levels, variable rate interest, and mortgages that are at least partly funded from offshore debt sources that has us greatly worried about the Australian residential market. When you put that combination of factors together, to us, on a risk-adjusted basis, the Australian residential market does not reflect good value. And in fact, the broader implications for the Australian economy are quite concerning, because what it means is, with variable interest rates and debt that's sourced from offshore, our interest rate settings are not completely within our control. So if interest rates go up overseas, that will be forced to be passed on to the Australian mortgage holder, regardless of the economic conditions here. And obviously, after 25 years of economic growth, there's probably an element of complacency in people's thinking around their debt levels. So that, to us, is a sign that we should be diversifying and diversifying globally. And we certainly think that global real estate still represents an effective diversification for all the reasons that we've highlighted there. It is an inflation hedge. It does provide a consistent yield. The liquidity, the diversification. I mean, the reality is, whilst a number of these technology, financial services companies, retailers will come and go, Martin Place will always be the place to be for the next crop of tenants coming through and companies coming through the system. But despite that long-term benefit of real estate, everybody today seems to be focused and fixated on this idea of REITs and interest rates and the yield trade. I mean, to us, the yield trade, we get it, because obviously there are some people who are particularly interested in a short-term yield. But if it's all about the yield trade, we're puzzled why we're seeing record prices in things like classic cars, even classic motorcycles, stamps, bitcoins, a whole range of investments and assets that provide no yield. So where do they fit into the yield trade narrative? Well, the reality is, of course, with QE and low interest rates and a growing economy, asset prices of everything have been increased. And REITs have been no doubt caught up in that. And I'm certainly not here to tell you that REITs are deep value, but they are all part of this trade, this reflation trade of asset prices. The other thing that we think hasn't been recognised, the thing that has driven REITs so strongly over the last 5-7 years, is not the yield, it's the fact that the market's missed. They've been a growth investment. They've produced superior earnings growth to global equities, right? And investors ultimately are rational. They're forced to be rational through the weight of cash flow. And the reality is that the REITs have produced superior earnings growth for over 5 years up until recently. So what we've seen obviously in the last 12 months, surprise, surprise, is not that interest rates are increasing, therefore pushing people out of REITs. Is the fact that the corporate earnings outlook has started to improve, thanks to things like, by the way, leveraged share buybacks in the equities market, thanks to also the tax cuts in the US. And so we've seen a rotation out of REITs and into equities. Nothing to do specifically with interest rates, it's just investors looking for better total returns. So investors are rational. They will look for the best growth, the best income yield, and combine the best total return. We don't believe that the REITs' earnings history, they don't grow as strongly, obviously, in the good times, and nor do they fall as badly in the bad times. But they are in a position to continue to produce what we think to be competitive returns. So if we look at the impact of interest rates, and again, people saying rising interest rates is bad for real estate. Of course it's not good for real estate. It's not good for anything because you've got a choice. You've got money in the bank or you can invest it. And obviously if interest rates go up, you might be better off leaving the money in the bank. But the reality is, in periods over the last 20 years when interest rates have risen, we can't find any clear evidence that it's had a negative impact on REIT prices. So those lightish, greeny, blue-coloured areas, they're periods of rising interest rates. The line you can see is the Global REIT Total Return Index, and you can see that during those periods of rising interest rates, REITs didn't appear to be dramatically affected. What did affect REITs is in that red area, of course, when we had a financial crisis, when we had a withdrawal of capital, and when we had a contraction in tenant demand. Good old-fashioned supply and demand and availability of credit. They're the things that we think specific to REITs are the things that you've got to be most cautious and careful about. So let's look at what is the situation in the real estate markets around the world to understand how vulnerable they are. And the reality is today, occupancy levels in global commercial real estate are near record highs. So landlords actually have pricing power because vacancies are low and they're able to generate rent growth today around the world running at about 3 to 4%, which in light of inflation isn't too shabby. So then it comes down to what is the supply and demand picture from this high occupancy level? Well, let's just talk about demand first. I mean, real estate houses the economy. So economic growth tends to translate into tenant demand. And as we know today, economic growth's pretty good, so we're seeing reasonably good tenant demand. Now, I will say, the thing that worries us most is that we do believe there's a lot of corporates out there who, frankly, are trading on this low interest rate environment and are yet to be really tested with more challenging periods. So that to us is a major concern, and if that's a concern for us, it should be a huge concern for equities investors. On the supply side, which is more within the control of the real estate industry, this chart highlights the amount of commercial property construction, that is supply, that's taken place in the US since 1970. And you can see supply today, in the lighter coloured line is a proportion of total stock. The hard, darker line is the absolute volume of stock. You can see that supply is remaining reasonably subdued. Now again, in the context of where occupancies are at record highs, you would think supply would be really responding in a more dramatic way, which would then again cruel the ability of landlords to have pricing power. But instead, we're seeing a more moderate response of supply for a whole range of different reasons. But that's the thing to watch for real estate, supply and finance, not interest rates. Interest rates affect everything. Now, again, let's just quickly contrast that picture with the Australian residential market, and you can see that supply has responded here in Australia to population growth, etc. And as a consequence, that's another thing to worry about with the residential market. Now, it's nowhere near as dramatic as we saw in Spain and not so much the US, Spain, Ireland in particular, and to the US to some degree, but it is a pickup. Oh, I just want to go back to the point I mentioned earlier about Australia's variable rate interest rates and our Achilles heel. What people don't realise is US mortgages are fixed for the life of the loan. They're 20, 25-year mortgages with 20, 25-year fixed interest rates. In Germany, it's over 10 years. And in other economies where it is a variable rate interest, level of interest, their typically source of funding, for example, as Japan, is Japanese households. So they're not reliant on overseas capital. That's our Achilles heel. I should have made that point earlier. And again, I mentioned earlier, availability of credit and too much debt. That was the thing that really burnt real estate in the GFC. And you can see that the REITs have been deleveraging. They haven't been tempted by these low interest rates to just go and borrow more and more. They've actually been reducing their leverage on a debt to EBIT level. Now, debt to EBIT to us is the best way of looking at leverage, but if you want to talk about a loan to value equivalent, that's about a 30% loan to value. Now, if you think back, private equity, private real estate funds typically leverage 40 to 70%. The REITs are at 30% or less. They've been pushing out their debt maturities. They've been hedging their debt. Their dividends are covered from cash flow. So they're actually in a very strong financial position. And again, I just put up on there just to highlight how the Australian household has actually been continuing to leverage up. Now, the other thing is, let's look at how REITs are trading relative to direct real estate. And you can see that it's trading basically at or slightly below the direct real estate pricing levels. And because the REITs have got such strong balance sheets and such good quality property, that's creating two things are happening. The REITs themselves are starting to look at share buybacks because they've got such strong balance sheets, because they're trading below the value of the underlying assets. So they're selling assets and buying back stock to take advantage of that arbitrage. Or what we're seeing M&A activity. We're seeing take private. And here in Australia, obviously, most recently, Investor Office Fund, taken over by Blackstone. So to us, that creates a real flaw for the sector. The ability, again, we've been managing money now for over 12 years in global REITs and longer in domestic REITs. We think a select approach does pay off by focusing on the best locations, the best balance sheets and the best management. So hopefully I've tried to address some of the great concerns around REITs at the moment, which is rising interest rates, to talk about the things that people should monitor, and that is too much construction activity. Remember the problems that got the Australian commercial property market into in the late 80s, early 90s, and the problems that then they're created for the banks. So supply and debt are the key issues. The residential market here in Australia to us is most vulnerable, and that investors are interested in total returns, not simply yield, but yield plus growth. And we think that REITs are in a very good position to be able to provide diversification.